Back on the Young Turks. All right, now we go after Tim Geithner, one of my favorite hobbies. Well, we're going to talk about the toxic asset program. Maybe he did it right, maybe he did it wrong. We'll find out. Let's talk to an expert. Michael Schlachter is the managing director of Wilshire Associates, and he's going to come on and talk to us about that. Michael, welcome to the Young Turks.
Well, thanks for having me on.
Michael, I know you're not representing Wilshire Associates in this interview, but just to give the background to our audience of what you do, what is it that Wilshire Associates does, and what do you do over there?
Sure. Wilshire Associates is a diversified financial firm. We have a handful of divisions that do things like private equity investing or make software products for institutional investors. So the risk management systems that, say, PIMCO or AllianceBernstein use are the kinds of things that we would create. I work in our investment consulting division. I advise the pension plans of states, corporations, things like that. Think of us as financial planners to $25 billion or $200 billion pension systems.
All right, so you're perfectly aware of how the high-level financial investments go and what makes sense and what doesn't, what the incentives and disincentives are. And again, just to repeat, you're not representing Wilshire Associates here, just your personal opinion here. So let me start with, what was the toxic asset program supposed to do?
Well, basically, the program was supposed to provide a backstop for the marketplace. What really happened over the course of the credit collapse last fall and into the fall of 2008 and into the early part of the winter of 2009 was essentially just a crisis of confidence, where any investor who might consider these kinds of highly structured asset-backed securities or commercial mortgage-backed securities simply no longer trusted the counterparty, no longer trusted the collateral. And so there was simply just, as I said, a crisis of confidence and a downward spiral as far as the potential for what these securities were worth or what anyone was willing to pay for them. So when the government came in with the TALF program, the Term Asset-Backed Securities Loan Facility, and then later the PPIP, which was announced, I think, in March of 2009, it was two different ways for the government to eventually apply some kind of a backstop or a floor to these securities so that at least the downward spiral would stop. And if you think back to where we were, you had things like the TARP program, which was obviously the cash loans or whatever to the large commercial banks. The whole reason we had to do that was because the assets on their balance sheets were so incredibly invaluable or marked down so badly, we had to reinfuse them with cash again. So essentially, the government came at it from two different standpoints. One, they gave the banks straight-up cash through TARP in order to, again, bring the balance sheets at least back up to something approaching zero. And then secondly, provide this floor so that the assets that were causing the downward spiral had a floor as well and might be able to bounce.
All right. So, and part of the reason they did that is because, hey, they thought these assets are not really valued as low as they were by the market at the time because of such uncertainty. And they thought if we can backstop it and hold the line, that they will rise in value to a reasonable one. Not back to what it was. They're not going to get 100 cents on the dollar. But that we won't have a panic, and that we'll be able to get this stabilized. That's roughly what they were going for. Is that right?
That's exactly right. And you got to think it wasn't just the assets backed up by TARP, TALF, and PPIP, but it was really any kind of fixed income asset across the board. High yield bonds, for example, had the highest yield spreads priced in the history of the high yield market. They were literally pricing in 98, 97% default rates. So it was basically the fixed income market was assuming that the world was coming to an end. And so this was one way of attacking at least one section of it. Again, asset-backed securities, mortgage-backed securities, anything with a hard collateral, not necessarily just unsecuritized debt of, say, a large corporation.
So we're not talking about straw men here, because some people will say, especially in the Obama administration, well, we had to do something, hence you must agree with us. What I said at the time when they announced the toxic asset program is, I agree, we do have to do something. The situation was dire. The question is what? And in this toxic asset program, what wound up happening, and this was reported in Bloomberg, and you were quoted in that piece as well, that it turns out the banks bought more toxic assets. Apparently, $3.36 billion of debt was added by the just top four banks. So, Michael, why did they add more toxic assets rather than getting rid of toxic assets?
Well, what really happened was you have to think the PPIP was announced, I think it was in March, again, of 2009. And eventually nine investment firms were hired to manage up to $1 billion of investor capital which would then be matched essentially 3-to-1 through a combination of equity and lending from the Treasury Department. So, talking about 9 times $4 billion in assets coming in from the various firms. That didn't actually begin to get funded until late September, early October. So you announced it in March, and then by September, October, November, these funds began actually to close. They finally reached capacity and began to put the money to work. So anybody who sat there for 6 or 7 months saw the equity markets begin to rebound, realized the world's not coming to an end, and realize you now have tens of billions of dollars of investors' capital coming in 6 months from now, in September or October. So essentially, it wasn't just large banks. Obviously, they were, as you said, guilty of buying these assets in the numbers you quoted. But it was a variety of asset managers. It was hedge funds. It was really anybody who had the wherewithal to purchase some of these securities did so. It's sort of akin to front running. I mean, front running is when you buy stock in advance of an announcement, hoping to profit on an earnings announcement or a merger announcement, something like that. This was legal front running. You knew that investment managers, clients, and the Treasury were going to step in September and October and put capacity to buy these assets in place, so why not buy them in August yourself? So, in March, we saw a pretty substantial spike in pricing. I think earlier in today's program, you mentioned how the prices are from 35 cents to 58 cents. It hasn't been a linear path. It happened on the day it was announced in March, and it really happened in about a 2 or 3 week span in late September once we realized that these PPI managers were actually beginning to put money to work.
Well, you see, when you look at those numbers, you could actually look at that and say, hey, you know what? There might be something positive out of that, because we wanted the toxic assets to get valued a little higher, to stabilize, right? So if they went from 35 cents on the dollar to 58 cents on the dollar, well, then that might be a good thing, right? Because that's part of the original plan, as we talked about. But we can't let the bankers then buy them back. I mean, the whole point of getting them to a higher value was this so that the banks could unload them, not buy more of them. So then that makes me think, if I've got this right, and correct me where I'm wrong, that makes me think, I mean, Geithner doesn't know what he's doing. Did he not think, hey, maybe the banks will buy more of these rather than selling more of these?
Well, I mean, this is either the smartest plan in the history of the world or the dumbest plan in the history of the world. If they didn't realize over a 6 or 7 month delay that people might, again, front-run the actual launching of the funds and bid up the assets in advance, then it was pretty darn stupid. If they knew all along that simply the Treasury stepping in and saying, hey, we'll be the buyer of last resort, if they knew that would prop up the markets, or they at least guessed that would prop up the markets, then with committing really a minimum of capital in a fairly risk-free, not risk-free, but very low-risk sense, at least for the Treasury, they were able to help a lot of this recover. I'm not quite sure how you would say, okay, hedge funds can buy this stuff, fixed income shops can buy this stuff, but Citibank can't, or Goldman Sachs can't, or Morgan Stanley can't. That's a pretty hard line to set. At the end result, the point at the end of the day was to allow a capacity to fix the bank's balance sheets. So whether you did it by bidding up the assets simply over that intervening 6 or 7 month period, whether you did it by buying them, the bank selling the assets to buyers in the third party, or if the banks were able to buy these assets themselves and begin to bounce back as the prices rose, that does shore up their balance sheets. I mean, this entire thing isn't pretty. The entire process, this whole past year, has been very much akin to open heart surgery. Nobody wants to get their chest ripped open, but if it's that or die of a heart attack, you really don't have a whole lot of choice. And so a lot of unpalatable things, I think, have happened as far as much of the backstopping, again, of the commercial banks. And so this, was this the final a straw that allowed the banks to come back to some kind of healthier position? Possibly. I mean, if they bought $3 billion, as you said, and they made $1 billion or $2 billion off of that, maybe that helps speed the repayment of some of their TARP loans, as we've seen over the past few weeks. Again, I don't think it's the best solution. I hate to see the Treasury bailing out and throwing profits now at these banks as well. But so many of them were just so far down that really it was a question of we have to do whatever we can to keep them really alive, because unfortunately our economy really is dependent on their continued survival more than anything else.
We're talking to Michael Schlachter. He's the managing director of Wilshire Associates. I want to touch on a couple of things you mentioned there, Michael. One, we had to keep them alive. Now, let's keep in mind why we had to do that. We had to do that so that they would start lending again and then the economy would improve, not just for the sake of keeping them alive, right? So, now, there are other reasons why we had to keep them alive. Let's understand that too, right? But we never got to that point. They didn't increase their lending. In fact, over the last year, the major four banks have decreased their lending by $100 billion. So, again, it makes me think, well, okay, Geithner, you wanted to get rid of their toxic assets so you can, increase lending. Instead, they bought more toxic assets, and they've decreased lending. Doesn't that make you a failure?
Well, it depends on your perspective. Lending did drop by $100 billion, but let's say in the absence of all this stuff, it would have dropped by $200 billion. Then what happens? So, everybody hoped that the banks would begin to lend aggressively again with these programs. Obviously, they didn't. There were plenty of cases of these banks using the TARP assets to make acquisitions, small acquisitions, to pay out bonuses, to shore up their balance sheets in other ways, to buy back debt in some cases, buy back stock. There's a lot of stuff that wasn't really intended that happened. But you're right. I mean, to some extent, it failed in that we didn't just give the banks this massive infusion, and on Friday afternoon things were terrible, and on Monday morning we woke up and things were great again. The question is, and I think it's really going to take probably a pretty substantial study years from now, once we can look back with some kind of objectivity on this entire period, how much worse would it have been in the absence of some of these programs? Again, lending dropped by $100 billion. Would it have been $500 billion if Citibank had gone out of business and something else had happened, something else had happened, something else had happened?
But Michael, that brings us back to our only two choices wasn't do nothing or do this. There were many other options, many other ways that they could handle it. And if they chose this and it didn't work, well, then they're responsible for it, obviously. Now, let me run another option by you, see if it makes sense or not. Couldn't we have at least said, hey, you know what, if we're going to put up 75% of the money here for these toxic assets, thereby creating an incentive, obviously, for people to rush into toxic assets, which is partly what we wanted to do. Shouldn't we at least get the equivalent amount of money back in returns? So, because it's, the way they set up the program, my understanding is that we don't get 75% of the money. We get a much, much smaller percentage of the money, and that's why people rushed in to buy all these toxic assets.
Yeah, the way the PPIP is structured, I don't have all the diagrams and charts in front of me, but essentially the government invests alongside the client, essentially, or the individual, dollar for dollar, and that portion gets a fairly high payout, which is fairly similar to what the investor eventually gets. On top of that, though, the government does do $2, again, for $1 invested in a debt facility. So essentially it allows you to leverage your investments 2 to 1. That needs to be paid off at a certain percentage rate, which is pretty low. I think it's like 5 or 6%. And then there's a preferred rate, which is paid on the the $1 in equity, which, again, matching the $1 of investor money. And that's, I think, something like 8 or 10%. That has to be paid out first. So the government, yes, has, to some extent, they've put themselves first in what's called the waterfall of the capital structure. So any cash flows really have to pay back the government before the investor, but it's doing it at a slightly lower rate. So the investor might have to wait 3 or 4 years to begin to see profits, whereas the government gets their money back in 2, but the investor, for their patience, gets a little bit of a higher return. So, yep, the government is taking all the risk here, taking 3/4 of the risk. They're putting up 3/4 of the money, and they're not making as much as the investor. But at the end of the day, they're not waiting as long either. So, to some extent, I mean, is there a better way of doing it? Could the government just put up all $4 as opposed to 3 of the $4? Quite possibly. I think that the Obama administration was very sensitive to looking too socialist. I mean, nationalizing the banks or buying the stuff themselves or whatever it is. And so the PPIP and the TALF enabled the marketplace to still buy these things, again, with government backstop, but at least it gave the appearance that the actual investors were individuals, not the government simply nationalizing assets and banks and everything else on down the road.
Right. I just want to make it clear to the audience why putting in 4 out of $4 instead of 3 out of $4 is actually a good thing. Because if you put in the 4 out of $4, then you get to keep all the profit. Okay.
Right.
Whereas if you put in 3 out of $4, you get to keep a small amount of the profit and take 75% of the risk, which makes no sense. That's why everybody that was allowed to, rushed into the program, because as someone else said in the Bloomberg article, it's basically free money. Now, that overstates it a little bit, right? But it's pretty close to free money. Now, why are we, as you said in the article, why are we giving free money to the guys who caused the mess in the first place? Which leads to my final question, Michael, which is, it seems that the Obama administration is confused propping the economy back up with propping the banks back up. It seems like they thought, hey, if we prop the banks back up, everything else will be fine. But that was a wrong assumption. And what we wound up having is these too big to fail banks that got bigger, that bought, in this case, more toxic assets. Yes, they propped the banks back up, and they're back to getting their bonuses. But their real mission of propping the economy back up didn't really follow. So, again, isn't that, one, a gigantic error in calculating how this system was going to work? And then, and number two, finally, just flat out wrong assumption.
Well, I think, again, it goes back, it's sort of like the lending question. I mean, yes, we're not bouncing back rapidly. Unemployment numbers still look pretty crummy. But how much worse would it have been if many banks had failed? So things aren't great. But bear in mind where we were January, February of last year. People were talking about this being as bad as the Great Depression all over again. And certainly, while the economy isn't rosy by any stretch of the imagination, it's a heck of a lot better than the 1930s. And we appear to be on some kind of a trajectory, at least flat, if not upward again, which again is much, much better than what people feared 12 months ago.
I got to interject one other thing then. I mean, in terms of what other things we could have done, right? Again, no one is suggesting we should have done nothing. We could have given the money to community banks who are lending. And instead we didn't, because why? Oh, the Wall Street banks have to be protected, because it was the wrong focus. Whereas if we'd taken the same amount of money and either lent it ourselves, bought the toxic assets ourselves, or given it to community banks, it might have served a much better purpose.
You know, I think, I mean, to some extent, you're right, and I think this goes back to the long-term perspective, which we're going to take someday. There are a lot of coulda, woulda, shouldas we could have done here. There are a lot of options. You know, again, talking about nationalization, talking about the government buying these assets, letting some of these banks fail, like we did to Lehman. There are a lot of things that potentially could have been done. I think that the government saw this as we need to do something fast. And while you could give small amounts of money to hundreds or thousands of community banks, giving the TARP assets and some of these backstops to a handful of very, very large mega banks is a bit more expedient. At least it gets large amounts of cash into the marketplace much more quickly than giving small amounts to 1,000 different community banks. Your question, though, back about that Bloomberg article, there really are two different ways for the banks to make money off PPIP. One is to be one of the 9 managers. Again, there are 9 of these managers who are matched 3-to-1 actually investing these assets. The other was simply to front-run the investments. And not a lot of the commercial banks who had these issues are in those 9, the actual 9 that were selected to manage the PPIP over the long term. But again, you could have bought an asset-backed security a week before the PPIP funds were funded and gotten this pretty substantial profit. It wouldn't be levered, it wouldn't be backstopped by the Fed. But if you knew that obviously the market's going to begin to recover once all this money flows in, you make a pretty substantial profit. So my comments in that Bloomberg article really were kind of double-pointed on both ways the banks are making money off of this, and what did seem rather, I guess, unfair, that some of these folks who structured these securities, created these securities, sold these securities in the marketplace, in one large investment bank's case, was short these securities throughout 2008 because they knew what they were selling was a bunch of garbage, then had them turn around and begin to buy this stuff, or engage in PPIP, charging clients a 1% fee plus a percentage of the upside, seemed to me really sort of like having a contractor burn your house down by accident and then offer to rebuild it. As much as it may have been an accident, that's not the guy I'm going to trust with my money to do it for me again. And I think that the commercial banks should be eliminated as well from that kind of a consideration, given why would you want to trust your assets with the folks who got us here in the first place?
And by the way, they made billions of dollars burning down your house.
Yeah, so, absolutely.
And one wonders if that was an accident. So a lot of reasons why the banks shouldn't have gotten the rewards that they did, and hence leading to the criticism of Geithner. And Obama in this case. And Bush, by the way. Let's be fair, because Bush also signed on to the TARP portion, at least before. The toxic asset was Obama administration, but TARP was also Bush as well.
Right.
All right, Michael Schlachter from Wilshire Associates, thank you so much for joining us. We really
Thanks
appreciate it.
for having me on. Happy New Year.
All right, you too.
Have a good night.
All right, we'll be right back.